This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on that red button over Luke's picture that says looking for the downloads. Eric, let's cover crude oil starting with those EIA inventory numbers.
On a national level, crude oil built 1.6 million barrels, but Cushing, Oklahoma drew down 1.9 million barrels, and the big drawdowns were on finished products, with gasoline drawing down 2.1 million barrels and distillates drawing down 2.5 million barrels. U.S. production holding unchanged at 12.2 million barrels. Tape action, brace for impact. It's straight down, and even before inventory, the market was in free fall. This really, I think, is a reaction to the SVB news. And as I said in last week's podcast, I thought a test of $66 was possible on WTI. Well, that's exactly what we got on Wednesday. We got a bounce off of that level. Does that mean that it's the bottom and the bottom is in, or is it just a dead cat bounce and we're still headed lower? I'm not sure, but the market is clearly pricing in the coming recession, and I don't know whether the selling is over. It really is going to depend on whether or not this banking crisis is ending or just starting. I remain very strongly committed to my long-term view that because of lack of investment, there will eventually be a global energy crisis because the global economy cannot return to pre-pandemic growth trajectory due to insufficient supply of oil and gas. The thing is, the global economy is nowhere close to returning to its pre-pandemic growth trajectory because it looks like we're already headed into recession and maybe we're about to have a banking crisis. Maybe it's already blown over. We'll see what happens. So bottom line for crude oil, it's going to really depend on what happens with the broader economy and broader markets. Obviously, if the stock market crashes and we have a banking crisis and it's 2008 all over again, then we're headed much lower on crude oil. There's a possibility that the $66 number that we saw on Wednesday was the final low, but it would take the banking crisis blowing over in a decisive way and seeing some action from the Fed confirming that or some news that really reassures everyone that there's no more systemic risk in the banking system. In that case, I think it probably is the low. So we'll see what happens, but I don't think it's possible to make a high conviction directional call here just because there's too many uncertainties as to what's going to happen next.
Eric, for me, crude oil, you're bang on that that drop to $66 was a possibility. We were looking for that as well as a risk that if the support lines gave out. The big question for me is in the coming trading sessions will be, will the bulls react on this with a buy on dip and get it back up into the trade range? For there to be a further weakness like you suggested could possibly occur, it would, to me, be failed price action to get above 70 and just day after day consolidating at these new lower levels. That could open the window for a short-term decline to 60 on the downside. But overall, my first approach to this is that this was just a washout. There was a lot of stop losses, a lot of psychology along all those major support lines. And when they given out, it forced a wave of selling as the support lines all broke. Will be very interesting to see whether or not the buy on dip traders can create a quick recovery in the coming days. Now let's talk the markets though, guys. Nick, I wanted to ask you here, obviously this was an incredibly volatile week. What was your take on the S&P and what levels are you watching?
Yeah, so last week I mentioned that I thought we might rally up before we came back down, but obviously the failure of Silicon Valley Bank came into play and we had that nice move to the downside prior to that. Right now, the expected move for this Friday's OPEX, which is a very important monthly OPEX, March 17th, it's tomorrow, we have an expected move right now of about 70 points from the current spot. So upside would be 39.60 or so, downside 38.20, and we have heavy support at 3,800 and heavy resistance at 4,000. Keep in mind right now, the largest open interest area is at 4,000 on SPX. So that's a large gamma flip area. If we get above 4,000, we could run pretty fast. And to the downside, the large gamma area is around 38.50 or so. So if we get below that and close below that, then that could push us further lows in the next couple of weeks or so. Now, obviously, the volatility's picked up a lot, and we expect a lot of whipsaw action. But it's important to remember to manage your risk in these times, and think about your risk reward in each trade individually. So again, downside 3,800, upside 4,000 or so. Those are the key areas to watch. Now, Eric, based on this, what are your thoughts here?
Well, it all depends on the Fed's next move. If they hike, the market will tank. If they cut, what does that really mean? Well, if they cut, it means that the Fed is losing control of markets. And that should be bearish. And I say they're losing control of markets because they're no longer able to fight inflation as they need to do, because if they did that, it would crash the market. They don't have the control. If they're losing control, that should mean the Fed put has expired forever. It should be very bearish. But crazy as it sounds, I wouldn't be the slightest bit surprised if they began cutting, if that caused a melt up in stocks to 4,300 on the S&P. Why? Because as Louis Gav explained perfectly last week, we have an entire generation of professional investors that have grown up believing that the only thing that matters is Fed policy, and when the Fed cuts, stocks go up. As long as people believe that, they're going to buy stocks if the Fed cuts, and stocks are going to go up, even though I don't think it makes any sense. If the Fed is forced to cut here, it means they are scared shitless of what could happen in terms of contagion risk in the banking system. That's a very, very bearish message, but I don't think it will necessarily be interpreted that way, at least not initially. Eventually, reality will sink in, but I wouldn't be surprised if it's up before down on equities in the event of a rate cut.
So my take on the equities is a little bit interesting, because I kind of look at the fact that we had obviously these bank failures. We had the bond markets make extraordinary moves, repricing what will be inevitably some sort of a Fed pivot. And you would think that this would have resulted in substantial broad market volatility. But we have a scenario where the S&P 500 basically dropped 200 points, just over 200 points in this past week. And we have a scenario where many of the past market drops were actually far more violent than this. We're holding above that support zone, Nick, that you were talking about, around that 3,800. I mean, this is a market that basically up till now has completely brushed off the fear associated with these bank failures. We'll talk about the Nasdaq chart here in just a moment, but to me, this is a scenario where, well, if the market isn't going to crash on this kind of news, then from just a reflexive perspective, that would imply that once everything settles down, there's definitely room for an upside breakout. Obviously, like you're suggesting, it's going to a lot of it's going to hinge on the FOMC and whether Powell does in fact accommodate in the market's reactions will be important to that. But every day that this market doesn't break below 3,800 increases the likelihood that the next impulse might actually be bullish. Nonetheless, Nick, let's move on, because I wanted to talk about this NASDAQ a little bit. What levels are you watching on the Qs?
Yeah, so looking at the NASDAQ right now, again, very similar to the S&P, we have an expected move of about 7 points by tomorrow's OPEX, March 17th. So upside would be around 307, downside around 292 or so. Key resistance area right now is at 300, which is right where we are right now. Key support area is at 290. And in terms of the gamma areas, the key gamma areas right now with option positioning, there's a large call wall right now at 310 or so, which is also the next area of resistance on the upside. And the large gamma flip area is at 305. So if we get above 305, chances are we push to 310 pretty quickly as well.
It's interesting about your comment there, Nick. Also, obviously, we have a big OPEX coming up here. And as all of these things roll off into next week and throw some, central bank stuff into the mix, it's going to potentially open up the volatility. But what's interesting to me about the Nasdaq, even more so than the S&P, is that when you look at a 2-week range, the Nasdaq is trading at a 2-week high or close to its 2-week highs. It's basically brushed off this entire banking crisis, and individual names like Microsoft and other things are doing very well. Things are turning up. The Nasdaq is holding solidly above its 200-day moving average. It's again, just back to that point I made on the S&P 500. The market doesn't seem to be so worried about this regional bank crisis and is actually almost setting up now for a potential bull breakout. This is so weird because obviously intuitively one would think that this would create panic, and certainly that was something we'll talk about here on the VIX chart on the next page. You would think that there would be some sort of panic and market selling, and it's just not manifesting that way. And so to me, I always like to look at the markets in a way that, well, if the one reaction isn't gotten, then the opposite is likely to play out. And so in this scenario, if the market isn't going to sell off on this news, well, once everything settles, I'll be watching to see whether actually the next response is actually for bullish breakouts. What I want to move on, though, on page 7, we have the VIX, the volatility index, and we had that spike in volatility finally. Obviously, everyone's grabbing at protection here in this kind of circumstance. But Nick, what I found really interesting is that we're not even near levels where we were back in October when the last major market sell-off was. So while volatility did spike, it really does seem to just be almost a very benign jump in volatility irrespective of the situation. What's your take on it all?
Yeah, so I mean, I've said for the past few months or so that the support area is around 18 on VIX, and the 25 area is a very key area. If you break above it, we can usually push like 35, and we spiked to 31 this week, came back down again. But I think this might be a delayed reaction more so. Like looking today, for example, the regional banks, even though they recovered a couple of days ago, they're back down again today. So, we're seeing names like FRC is down like 30% as I speak, 35% as I speak. You have Western Alliance Bancorp down 12%, and PACW right now is down 18% or so. So it's possible we see more fallout in the coming weeks from this crisis overall. And that could be the catalyst, the next leg up in the VIX, right? I am surprised we haven't seen, further downside movement overall in broad markets and correlating spike in the VIX to 35 or so, because when you talk about bank failures, that's a pretty big issue that reminds us a lot of 2008, 2009, right? But again, here right now we're expecting, based on the VIX levels, about 1.7% moves per day in the broad markets. So, and we're getting that roughly each day. So it's important to understand the expected moves each day based on the VIX alone in broad markets and plan accordingly. And as I said before, the 0 DTE SPX options are acting as hedges in the shorter term than the 30 DTE. So that's kind of suppressing the VIX because the demand for the 30 days till expiration contracts is not as high as the 0 DTE, right? So that could be a reason why we're not seeing this huge spike in the VIX as we've seen in the past, perhaps. Now on page 8 here, we have the US dollar index, which has been on a bit of a run the past few weeks or so. And we have FOMC next week. We just had CPI and PPI. So it'd be interesting to see what Powell says next week, which will affect the dollar greatly. But what are your thoughts here?
Well, the rally we've been watching in the dollar was halted by expectations of either a pause or a pivot from the Fed in reaction to the Silicon Valley Bank events. But I don't think it's that simple. The market is waiting, I think, for the Fed's next move. So we'll see what next week brings. But I don't think it's as simple as assuming that the Fed is absolutely done hiking here. I think it might be just a pause with a possibility of a hike on May 2nd.
Well, Eric, we're recording this here before we know what has come from the ECB. And one of the interesting things will be obviously what reactions will come on the euro that could certainly influence the first impulse to finish the week on the dollar index. But obviously all eyes will be on that FOMC meeting and whether or not there is some degree of a pivot or at least a stall in the rates. Overall, the dollar was incredibly oversold and it's been mean reverting. And the way I kind of look at this is that if the reversal we had yesterday sticks in any way in the post-ECB period, then we could still have a move up to 107, 108 on the upside. We'll certainly have to see how this plays out.
Now on page 9 here, we have the chart of gold futures, which have been in a nice bull run the last week or so. And looking at this chart here, it looks to me that we're going to possibly break to new all-time highs, again, as investors flock to this safe haven commodity. What are your thoughts here, guys?
Prior to Silicon Valley Bank, I thought the correction wasn't over yet and we still had lower to go. Now it's much more complicated. If the Fed pivots, like many people expect, and starts cutting rates, gold should go to the moon. I mean, it's already up more than $100 since Silicon Valley Bank. It'll go up another $100 if the Fed cuts here. And that's what will happen eventually. So I think that the longer-term outlook is definitely very bullish for gold. But I'm not convinced that the Fed is done hiking, and most people seem to be, but I'm not. I think they're most likely to pause this month, let the dust settle, watch the data, and maybe hike again on the May 3rd meeting. If that were to happen, that would mean that gold maybe still does have lower to go, and we'll see what happens. Maybe we will get down to the 1780 level that I was hoping to buy on the dip. Ultimately, though, what the Fed does next is going to determine what happens for gold. It will go down so long as the Fed continues to hike, and when it's eventually clear that the Fed will give up on fighting inflation, and I know that's coming at some point, I'm just not as persuaded as a lot of other people are that we're already at that point. When we get to that point, and they start to cut to rescue the economy from the recession, that's when gold is going to move sharply higher. So long-term, the bullish view is very clear. Short-term depends on the Fed.
Yeah, Eric, you're bang on there. Like ultimately, gold could have been in the gutter for even 6 months or more, waiting for inevitably when some sort of a pivot and easing cycle could potentially begin. The fact that this regional bank crisis has kicked in and bond markets continue to increasingly price in, the fact that the Fed is likely to stall, that certainly has moved up the timetable for this potential gold rally. The big question, will it happen? To me, the first reaction is always positive. Clearly, gold is advertising that it started some sort of bull run. The big question is, can they hold on to the gains? To me, long as dips are being bought, even if there's a temporary break below 1900, I'd love to see buy on dip traders immediately get it back above 1900. Just I want to see the general pattern of accumulation really continue to confirm itself here. Obviously, with the ECB later today and then subsequently the FOMC next week. There's lots of news that is going to be the catalyst for the next gold move, but certainly initially looking pretty bullish. All right, guys, I wanted to wrap up here with just looking at bond yields. On page 10, I have the 2-year yield, and on page 11, I have the 2-10 spread. And the 2-10 spread went from minus 110 basis points to at one point trading at minus 40 basis points, just an extraordinary steepener kicking in. And it really was driven by an outright collapse in yields at the 2-year level. And that really came, obviously, as the bond market suddenly, in a shocking way, had to start pricing in this Fed pivot. This is a pretty serious and meaningful turn in bond markets, and will be really interesting to see is if this steepening trend is actually the new norm. Are we going to see a scenario where we're going to start suddenly see the yield curves get positive again in the coming weeks? It's certainly the thing to watch as we move forward from here.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.